Now we're under the assumption that you've received a completed FAQ from the vendor. We'll go back over to the input income statements, which we are now going to adjust. You'll notice that a few of the expense line items are automatically normalized. These are amortization, depreciation, and interest expense. Amortization and depreciation are automatically normalized in the calculation of EBITDA and are added back in the calculation of EBIT. Now looking at our normalizations, note that a positive normalization will cause a decrease in expense accounts and an increase in revenues. Of special interest is the normalization for owner's salary. The fully normalized value for this should be equal to the fair market replacement salary for the owner's position in each fiscal year. This is the difference between SDE and EBITDA and is used throughout the valuation process, so ensuring that this is correct is very important. Each time we make a normalization, we should also leave a note beside explaining what it's for. These notes will later be incorporated into the reports that you present to your clients and into the marketing materials. Moving over to input balance sheet, the most common adjustments we do are to do with what items are retained and what are transferred. Note that if we put something in this adjustment/retained column here, that means that this dollar amount of the relevant balance sheet item will be retained by the seller and not passed on to the acquirer. These items will differ in an asset sale, where working capital other than inventory is typically retained, and a share sale, where it will typically be transferred. Cash and debt are usually retained, as well as shareholder and intercompany loans.